Where do we stand today? We are looking at a macro scenario, which is very scary because the treasury market is getting repriced. We're looking at a situation in China, which is scary because Xi Jinping is reversing back to Maoist policies. And we are caught in the middle as equity holders, particularly long risk holders. We're disruptive investors, so meaning we invest in fundamentally new concepts and engineering practices. And therefore, we are at the long end, at the long duration of the risk curve, as the equity professionals call it. In other words, we are in the worst position to be, and we're feeling it. We're down 50.6% for the year. So I think the scoreboard doesn't lie on this front. And I think this episode is State of the Union of Orange Capital Partners. I think it's necessary for our clients, it's necessary for ourselves. And the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So, we've always said volatility is part of the game, meaning it's not just part of the game, it is the game. So you have to be able to withstand volatility. In a sense, you have to, as an investor in fundamentally new concepts and engineering practices, you're constantly getting through the fog of war. Like you don't even have a vocabulary to really talk about what you're doing because it's new. And of course, we hope to see light at the end of the tunnel. In other words, we hope to see the fruits of our labor materialize in profits. We've seen that so far. Orange Capital Partners has been in business for roughly 14 years, and we have delivered good returns. Though they have been diminished recently, but we're still fine, much better than most comps, much better than our vintage, sort of the hedge funds that started around when we started. Even though I haven't done precise statistics around it, I'm pretty sure I'm right about this because we started in March 2008, and that was 6 months before the financial crisis, and we made money that year. In other words, we actually outperformed probably 99% of any player in the market at that time. And then we continued with pretty good returns. So I think just anecdotally, I think we definitely outperformed our vintage. So we've been relatively successful, maybe not as successful as we'd like to, but this episode is not about how I feel about our own success or not. It's about where we stand today as a fund. This is not even on podcast. It's November 4th, 2022. This is Krim Delco. For today, the fund is down 2.2%. The market is roughly flat. We are down 50.6% for the year. The market's down 21%. We're underperforming by 29.6%. This is almost the worst performance we had for the year, almost the worst outperformance. We're basically almost bottoming out. That doesn't mean it's the end of bottoming out, but given year to date, it's been a little bit worse, I think, around July. Nevertheless, doesn't really matter in terms of where we stand relative to other months. I think what matters is that it's just not getting better. And it might even get worse. And we have to tighten our seatbelts here because there's two big shifts on the macro side that are concerning us. One is the Federal Reserve is not going to let go. In other words, they're going to keep raising rates, and they pushed the terminal rate up in the last FOMC meeting. This is why we're seeing a sell-off this week in particularly in our stocks. I think as far as Tesla is concerned specifically, I think the China risk is also a serious risk that we have to take into account. And I don't know why the stock is selling off today. I have a feeling it's probably driven by China because also Apple is underperforming and they have the same problem. So let me talk about China first, and then I'll talk about the macro side of things which are concerning us. Okay, so China, what's the problem in China? Xi Jinping has had reconfirmation of his power, and he has set up basically a slew of confidants around him that are, for lack of better words, drifting towards Maoism. What does that mean? It means that obviously Maoism means a lot of things to a lot of people. From my point of view, it means irrational, politically driven policies that are going to punish performance, Western style, Popperian style thinking. In other words, entrepreneurs, both in the business side, also in the political side, intellectual side, anybody who's trying to improve, change, get things better, change things, all of that stuff is being thrown out of the window here because Xi Jinping is going totalitarian, and Mao has done a few things that really destroyed China, the Great Leap Forward being one of them, and the Cultural Revolution the other. And while it's obviously not as bad, it is certainly going that way. The Cultural Revolution has not just hurt people, it has systematically undermined the competitiveness of China. And it seems to me that Xi Jinping is on the same path, because the brain drain, the capital drain, the reputational drain of China is massive here. Think about it. If Apple is not sure about their production capabilities that they have within the context of Foxconn on Chinese soil, well, all this manufacturing infrastructure that was built over the last 30 years started with Deng Xiaoping, mimicking, let's say, the free economic zones that Singapore pioneered, and then a little bit maybe also Hong Kong, but particularly Singapore, and then starting with Shenzhen, and then sort of expanding Shanghai, so on and so forth. All of that's being thrown out the window because of some ideology or some sort of power struggle or something. Honestly, it's beyond our understanding why they're doing it, but they're doing it. And for us at Tesla, we've said that several times. We have to start pricing in the possibility that China is going to be, at best, some sort of that cat that produces and sells within China, and maybe somehow at least keeps the cash there, and just sort of operates as an entity of Tesla, but not really being priced anymore in the market. Not as bad as, let's say, if you had a factory in Russia now, but sort of along those lines, where maybe there is just no value attached to the factory and the whole production and the market in China. And that would certainly hit us, like I said, maybe $200-300 billion, which would be 40-50% in the stock. Now, there are offsetting factors here, certainly, maybe not short-term, but long-term. And the biggest offsetting factor that we identified is the fact that the reason Tesla actually went to China in the first place was, in our view, to compete with China. So if you want to make sure that you're not going to get disrupted by Chinese competition, well, go there and compete. This is something that Vinod Khosla said maybe 10 years ago. He called it the Chindia test. And I'm not a big fan of Vinod Khosla, and he's turned from investor to snake oiler, if you ask me. But nevertheless, he said many good things way back when he was an investor and an entrepreneur. And okay, I should take that back. He's not a snake oiler. No, that's too much. He's just whatever. He's all right. So here's the thing. He said Chindia. So what is he saying? He's saying, look, if you want to, this is early 2000s, right? China's growing, becoming a monster, all of that. If you want to compete in any market, you have to be able to compete with China and India. Now, that has turned out to be actually wrong. India is not a real player in anything, and China has been, but has decided not to be. And that's exactly what's happening right now. So that's a good thing in the sense that, well, because we don't see real competition in the West, Nikola or Rivian or Lucid, all of these companies are not serious competitors, and the OEMs, the traditional IC OEMs, they're even worse. So from that perspective, we're fine. So we have a little bit of a positive vector too, but we have to get through this. And if Tesla gets repriced because China, hopefully it happens when we have Austin and Berlin full up and running, and maybe also the first factories in maybe Canada, Oklahoma, wherever the next factories will be. It will hopefully mitigate that a little bit. So that's kind of the situation. I think it's a serious situation. We shouldn't underestimate it. And for us, of course, Orange Capital Partners, the question is always, well, what do you do now? Do you sell? You see, this is the fundamental existential question that I have as a fund manager. Well, I mean, I can identify all these things, but I don't know where I stand in terms of the stock. And unfortunately, in the last couple of months, I've been right quite a bit in my predictions of what's going to happen on the macro side and all of that stuff. Interest rate side, not so much. But nevertheless, I had a feeling that things will be tough, but I didn't act, and I keep losing money. And there's a legitimate question, well, why don't you act? And the answer has been, well, I don't have technology and know-how into timing. So I don't know how to time these things. And we've said on this podcast several times that you really only have one degree of freedom as a hedge fund manager, which is you choose what to buy. And then you hold on to this for as long as you can. Now, of course, I have to caveat this because, well, you can be wrong. And we've been wrong in the past. We bought Twitter, we bought GoPro, we've shorted Deutsche Bank, we've shorted the Brazilian real, we've shorted companies like Brazil Foods, a couple of other things. We've been doing stuff and we got out of these positions. In fact, the shorts, almost always we got out too early. In other words, we didn't make any money. And we lost money on Twitter, we lost money on GoPro and so on and so forth. Now, why am I talking about all of this? Well, you can be wrong. And the way you're wrong as an investor is if your thesis doesn't work. And in the context of Tesla, that means we're looking at what the company is doing. There's the pillars of growth, which is AI, manufacturing, scalability, energy, but primarily manufacturing, scalability, and AI. Those are the sort of the pillars of growth. And of course, they're intertwined. I don't know if that's a word. Intertwined, I think that's the word, where we have the humanoid robot, which will help scaling manufacturing and so on and so forth. So as long as that thesis is intact, we don't have a reason to sell. If Tesla loses its edge on the AI front, if Tesla for some reason is not the best company delivering physical AI, if Tesla is not the best company delivering AI training and inference capabilities in real time to drive a robot and then also maybe drive a humanoid robot in the future, if those are the if that's the situation, well, then we have to rethink. If the macro side turns against Tesla, that's not a reason to sell. Why is that? Well, because it's not under control of the company. That's not part of our mission. Our mission is not to predict macro moves. And that's a big problem. A lot of our investors over the last decade and a half have left us, because of that. Because it is a human natural reaction to say, if you think China is bad, you get out. Well, yeah, not so fast. Google got out of China. Amazon is, as far as I know, not big in China. Intel's not big in China. Microsoft is not that big in China. They have business there. Apple is big in China, actually. But the business is not so important. But of course, they have their production there, so that's a different situation. So, not so fast, okay? The world's big enough to generate wealth without China being in the picture. Like we said, the main reason we invested in China, we as investors of Tesla were supporting the investment in China, was because we thought that that is the best way to compete with the Chinese onslaught of disruptive competition. That's why we thought it was a good idea. And that, again, that vector has disappeared from the landscape, at least for now, and therefore it's fine. So to summarize the Chinese situation, we are assuming that it's going to be a drag on the stock for a while, and that it's going to have a possibility of even getting worse because of Xi Jinping's policies. But we're not selling because A, we can't time these things, and we don't know. We don't have knowledge and know-how over how this will turn out. It could also turn out the other way around, that Xi Jinping threatens and then actually doesn't follow up. But fundamentally, we're still okay with this underlying investment, and this is what matters the most. So now let's talk about the second big factor that we're facing as investors, and that is the Federal Reserve. Just to summarize the events of this week, we had the FOMC meeting, and the Fed said that they basically don't see any relaxation in the labor market, and therefore they expect rates to keep rising and the terminal rate to be higher than expected. This is the message, and that's why the stocks sold off. There is a little bit of push and pull in a sense. They're going to raise rates maybe a little bit slower, but the terminal rate's going to be higher. Now, from our perspective, that is absolutely understandable because we've said many times in this podcast the real reason why all of this is happening is because the labor market is tight because people aren't going to work. They're either physically not going to work or they're sitting at home pretending to work remotely from home, which is a massive drag on productivity, and at constant wages, that equates to a real wage increase, and that's why we have inflation. Now, the Fed knows that for sure. I'm not the only one who knows that. They're not saying it because it's politically laden. It has to do with labor laws and all that kind of stuff, and can't just fire people, particularly a woman that just had a child and wants to work remotely, and you can't fire them, although their productivity probably is even worse than 50%. When I say 50, that's an average, because there's certainly some jobs where I would say productivity is even higher, particularly software type stuff. But overall, I think just look around you. Just look at your friends. Look at yourself. Imagine yourself working from home in a pajama versus going to work. It's just different. And there are certain people, like Andrej Karpathy types, they are as productive in an office, or maybe even more productive if they're not in an office, but they're self-driven. They're driven by the types of people that, they're 0 to 1 type people. That's not what most people are, and therefore we have this problem of shortage of labor because, again, 70-80% of our economy is service-driven businesses. People work from home in those businesses. They're not productive, so businesses have to hire more people. If you're a paper pusher at a bank, you work from home, then you just need a few more paper pushers to get the same job done. Then we have the other problem, which is the physical work, the blue-collar work. People are showing up sporadically, using COVID and things like that as an excuse, still getting paid. Again, if you're a restaurant, if you're a factory, you just have to hire more people because half of them don't show up. So there's a big problem there that could be or could not be fixed with elections and midterms and things like that. To us, this is a hopeful sign. We have a right move towards the right on the midterm elections, which hopefully will at least streamline Congress a little bit in terms of wasting money on the government level, hopefully also making it difficult on the federal level to support all these lax labor laws, or maybe not laws, but this culture. This is a culture. This is much worse than a law. It's a culture now where people, like I said, they think they can work from home and just pretend to work and all of that. And we're seeing it, particularly, let's say, you have software as a service stocks. They're collapsing 80-90% because those are the kinds of companies where people are working from home and they're just not able to deliver nothing. And that is a big price to pay for what's called flexibility and not having to commute and all that. Look, I'm not against not having to commute. Commute is depressing. The problem is we haven't found a way to keep productivity constant or increase productivity by having people work from home. We just haven't. Just having Zoom or things like that, that's not enough because that's not what productivity is not about. Being able to communicate. We had FaceTime and all that kind. We have telephones. We've had that for decades, and people still work in offices. So there's definitely a lot more to it than just being able to communicate, and I think we're seeing that right now. So this is the price we're paying. Now the Federal Reserve, what they're doing is the Federal Reserve is actually just using the sledgehammer. They're saying, look, our ability is just to slam the economy. And then hopefully when demand slows down, everybody will get to their senses. Another thing they're doing is also they're moving out of the treasury market to see where the real price of treasuries is. And that's a big ask because they've been a big player in the treasury market for such a long time that now where is the private market coming in? Now at 4 or 5%, I would say people are probably going to be happy to buy treasuries. It's actually not inconceivable, maybe 6%, but there is certainly a percentage where you're happy to own U.S. treasuries in U.S. dollars. I mean, it's not inconceivable, but again, where is that price? That's the big question, and we're dealing with that right now as investors. So those are very big moves, tectonic shifts, If the treasury market underlying everything is shaking, then of course everything else is shaking. And we're feeling that as investors right now. To use a phrase, we're learning that the hard way. So to summarize the two big events that are driving our terrible performance this year, one is China and the sort of Maoistic feel that Xi Jinping is certainly the message that he's sending, and the feel that he is sending to the rest of the world, which is putting Tesla's China business at risk. And second, the Federal Reserve fighting the culture of basically people not working or not working nearly as much and as hard as they used to, driven by two factors. One is remote work, and second, the ability to just not come to work if you have excuses such as pandemic-related illnesses and all of that. And I don't want to diminish the fact that some people are really getting sick, but unfortunately, human nature is such that the free riding is happening here, a typical economic concept. So while there's certainly people who legitimately shouldn't be going and mingle around other people because they're sick, it is unfortunate that a lot of people are just taking advantage of that, and therefore making it more difficult for employers to hire people, and that is putting a big strain on the economy. And the Federal Reserve is using their sledgehammer, which is interest rates, to slow down the economy. Now, on the positive side, so once all is said and done, we're left with our mission at Orange Capital Partners, which has always been the same, which is we invest in fundamentally new concepts and engineering practices with large impact. That isn't changing. That has nothing to do with labor or anything like that. That has to do with the ability of our underlying companies to actually innovate and through constant iteration and error correction, get better results in their particular technologies, deliver products and services that are not just better, but also at lower cost, and therefore grow and generate wealth. This is our mission. That hasn't changed. So what are we doing right now? This is the time to build. This is not a time to panic. We have to make sure our leverage is intact. I've always said that. We have to make that. It's not just our leverage in the portfolio, it's our cost structure, our living cost, the cost structure of the fund. All of these things have to be held in check. And we have to build. This is the time to build. This is the time to educate ourselves, to generate content, to write podcasts, to read, to meet people, to help people, to advise people as much as we can, get advice from other people. That's the time to build, and we're fully in it. Thank you.